What's up, everyone? Welcome to Fear, Uncertainty, and Doubt. This is your weekly FUD podcast, where we come at you and cover the hottest and most interesting topics in crypto, macro, tech, whatever's interesting. I'm Kevin. I'm here with Brian and Carlos. We are creators, analysts, builders, engineers in this space, right? So today we have some really interesting topics. Over to you, Carlos.
Yeah, sure. So I think kind of the first thing that we wanted to talk about was the AAVE stablecoin, pronounced Go, I think, like short for Ghost. And it's pretty interesting to see something like this come out from a huge platform like AAVE, especially at this time when there's kind of been a lot of problems with stablecoins in the past few months. And so I think this has started to generate some hype just for that reason of they're doing it despite kind of tumultuous market conditions. But I was doing some reading, so I'll just do like a quick overview of what I kind of noticed about the stable coin. Well, first it seems like very like baseline. It seems very similar to Liquidity, if anyone's familiar with that. And so Liquidity was a Ethereum stablecoin protocol, whatever, that got forked like a million times onto all the other chains. And basically, the way that it worked was, you can, for Liquidity, you could take out like these kind of interest-free loans, and they give you like one of their stable coins that they mint. And basically, like, you have to over collateralize it. So you have to put in, maybe on Ethereum, you have to put in at least 110, 120% of whatever you're taking out of Ethereum, and then you kind of like mint these stable coins. And then so that's kind of the first thing I noticed, is that it really it represents that quite a bit. And then of course, like, the liquidity mechanism for if it goes under peg is you can always just arbitrage it, and you can always exchange one liquidity token to get $1 worth of ETH. And so that's the first thing that stuck out, is like, this is not, that new, though I did notice that there are some notable differences, of course. Some of the interesting differences that I noticed are, one, this is not going to be free. So it looks like there are going to be borrow rates to borrow this Go coin. And those, actually, what was really odd to me is that those, rates that they can set are actually set by the DAO. And so, it is important to set rates based on market conditions. But, something that really popped out to me as concerning was, the kind of like community controls, like what the interest rate is going to be. And so this seems a little weird. Like, it seems like, I know this isn't an algorithmic stablecoin, but it does seem like, if interest rates are kind of at the whim of a DAO, you could have some like weird manipulation or something happening that's kind of like subject to human intervention, right? So that's kind of the first thing I noticed. Do you guys have any thoughts on that before I kind of continue?
So yeah, I think when I first saw the news drop on Twitter, I kind of had the wrong impression of it, because people were like, why are they still doing this after this whole like stable coin fiascos happened? And so I thought it was an algo stablecoin, but it's really just letting you put in your staked assets into AAVE, and then you can borrow this Go stablecoin, essentially. So
Right.
the staked assets will like continue to generate interest. But one thing that was really, really interesting to me is that the LPs will not receive, quote, most of the Go's borrow interest paid. That is going to the DAO treasury. So I don't know. I feel like it would be more enticing for the LPs if that was passed to them as well.
Right.
Because
Yeah.
it's not a lot, right? Like, if you look at Aave's rates that you earn as a lender, depositor, they're not that high. They're pretty low, like 1%, 2%, 3% for the vast majority of the major ones. So yeah, it just feels like they're not incentivizing it as much as they can. Maybe that's more like sustainable this way. But yeah, that's just one thing that jumped out at me in terms of
Yeah.
something that's like a little bit weird.
I feel like I wouldn't really be, enticed by like 3% if that's like what they ended up offering, right? That's too low. Like I'm just gonna, take my USDC and like stake it somewhere else, that just seems too low for me to care about this at all. So that's actually kind of an interesting observation. Do you know if they take any of so it sounds like you can put staked assets like as collateral. I didn't realize that. I thought it was just like you can just kind of like the same as the liquidity model where you put in, whatever assets and then you can like borrow against those. But it sounds like you can put in like already staked assets. Do you know if they take
Um,
a?
no, I think it's what you were thinking. It says
Oh, okay.
you're just borrowing stablecoins against your holdings, which are whatever Aave supports,
Okay.
and it needs to be over collateralized as per any normal Aave loan.
But can it be like staked? Like if I have whatever like Ethereum staked on Aave, can I take out the loan against that?
Um, Ethereum staked on Aave, as opposed to what? What's the other
As opposed to
scenario?
just like holding it, right? As opposed to just like having the Ethereum.
I believe so. I believe you
Okay.
can. Like,
Well, yeah, it's you deposit your ETH into Aave, right? And then you basically get some amount of stablecoin you can draw out against that ETH, right? I honestly, this sounds very similar to DAI, especially if you start talking about like community governed interest rates and stuff like that. That's essentially what Maker's doing with DAI. So in a lot of ways, this sounds very very similar to that. Um, yeah, it's interesting. It
what was the
could
one?
there could be there could be benefits, like even if you know um, there could be benefits for depositors in that maybe they are able to get stables at a subsidized rate by the DAO. Like there could be some, if you're depositing assets there, you're able to generate a stable coin at like a cheaper rate as compared to borrowing from Maker or yeah. So there's some maybe advantages they can work
Well,
out with that.
so on that note, if you hold staked Aave, then you can potentially mint and borrow Go at a discounted rate, which is yet to be set, I believe.
Gotcha. So that's like some tokenomics, right?
Actually,
I guess
this whole thing is still a proposal. So everything we're working
right,
on right now is like the info we have and what they've
right.
proposed.
I guess the thing that I'm still confused about with this is like, you know, with liquidity or something, you put in your Ethereum, you get out some stable coin. And like the big thing there is like, I'm holding Ethereum because I'm speculating on it. And I get the stable coin so that I can be kind of like more capital efficient as I speculate on Ethereum. What I'm not clear on with Go is, if you like, let's say you're like adding liquidity or you're like staking a token, can you borrow against that? Do you know what I mean? Like you're earning some yield on maybe like some staked Ethereum or something, and then can I borrow against that pool, right? Like that position of the pool rather than like the raw underlying asset.
So like borrowing against the LP token,
Exactly. Yeah, exactly.
isn't that what like MIM does? Was it
Yeah, I
MIM
mean,
or some other project that lets you do that?
that would I mean, I think that would just require different. I mean, there's a history of Aave actually trying to do this. I remember, you know, back in the day, they tried to do Uniswap LP tokens, which is essentially what you're talking about. They've also tried to do. My company Set has worked with Aave in the past to try to get our indices listed. But the way they do that is all in separate markets. So they have their kind of like main market, which is all the tokens, and then they've in the past looked at trying to add some of these like LP token markets, index markets, stuff like that. Those never really took off or got much traction, or were just kind of like stopped before they got super far.
Right.
But to that end, there are different. So as far as like I would understand it, as long as those things are enabled in the protocol, you can then borrow against them. That said, they generally are riskier assets, and so they're going to have different like, borrow requirements, and stuff like that.
I guess the other thing, I'll kind of just jump into this.
Yeah.
The other thing that I noticed about Go, which is kind of interesting and also still like a little weird to me, is that they introduced this concept of facilitators. I don't know if you read about this as well, but it seems like there are a bunch of entities that are given some allowance of Go to mint / burn. So they kind of have some autonomy on how those tokens are distributed. And like they have to get approved by like the AAVE governance, like the DAO presumably. But one thing that I noticed is in their flow chart, they had a flow chart about this in their docs or in their proposal. And in their proposal, one potential facilitator that they listed was actually an under collateralized like lender based on like credit score, which they didn't actually explain anywhere that I could find. But it seems like they have some ideas beyond kind of just something more traditional, right? With this facilitator model. So I'll be interested to see and I think as the proposal comes together, I'll be interested to see who they're thinking about to have as like initial facilitators, right? Because I actually don't really know how that's going to work in practice. If you like delegate, it's more decentralized, I guess, in a way. But I just don't know, is that could that be like manipulated? Again, could that be manipulated? Is there any risk involved in kind of farming out this mint burn functionality of this Go token? So it'll be interesting to see them talk about that a little bit more. The proposal was still a little bit sparse in that area.
So the facilitator concept essentially forces things to grow at a more controlled pace, right? Because they don't get unlimited ability to mint and burn Go, as per my understanding. They have allowances or limits for each one. So I think that kind of I see a lot of stablecoin projects get more conservative these days and put limits just all over the place. And I think that's good. So it kind of pumps the brake on any runaway growth that they can't control, like what happened with UST. Actually, This is a little bit of a tangent, but Near Protocol, they had USN that was going to be double collateralized with USDT Tether and Near, because they had the same on-chain swap arbitrage mechanism as UST and Luna did. But they came out with a version 2.0. It was already launched. Okay, it's already live for several months. They came out with a version 2.0, and they basically said that they looked at the stablecoin landscape, they redid their calculations, and everything is too risky. With FRAX, people don't really fully trust it yet, even though it's half algorithmic, half collateralized. With USDD, the Justin Sun's stablecoin, that lost its peg for a week, even though it is triple collateralized essentially. So they're okay, we want something that in the bear market can sustain anything that people throw at it.
Yeah.
So they decided to switch it to be fully collateralized by Tether, and their on-chain swap is switching from Near to USN, which would be Luna UST model, to USDT and USN for a similar on-chain swap. So they're making it super backed by other trusted stablecoins, and they say during a bull market maybe they'll add more volatile assets to the reserve and to the swap mechanism and things like that. But for now, they say they just want to do something that's going to sustain. And I was shocked to see them completely switch the plans. But that, I think that kind of tells us the appetite of stablecoin issuers and projects.
So let me ask you this question, because this is what like I've kind of been wondering this for a long time, and I have some ideas. But why do all of these stablecoins exist? So there's a huge basket of stablecoins that are in existence now, and for some of them, like Go, I think it kind of makes sense for Aave to mint this because what I see here is that it allows them to kind of like lock more people onto their platform. So if you borrow Go against some of your underlying assets, they have to be on Aave already. And then so when you've like taken out that loan, you're using that for something else. It kind of like locks you on that platform. But is that kind of like the goal of a lot of these other stable? Like, why do they all like? There's so many that exist.
Yeah, I mean, I was reading some articles from different projects making their own stablecoins, and I think one big reason is because they think it's such a massive, like, total addressable market for stablecoins, right? Like, if DeFi is going to take off, you need stablecoins, and even if DeFi doesn't take off, like just with regular everyday commerce, right? Like Bitcoin is supposed to be that internet payments, but stable coins are what like Argentinians and Venezuelans prefer because it doesn't have the volatility that Bitcoin does right now. So they just see a massive opportunity, and it also adds a lot of growth and liquidity into their own ecosystem. Like a lot of them want to really become their own central banks. So they need their currency, they need like be able to set rates, and they need to be able to offer like markets on either side of it. So they want to build all these different components around it, and like I think it is a big opportunity, but we'll see which ones are able to do it properly.
I think another thing that's kind of interesting is that like it might add it might add resilience to the ecosystem to have a lot of these kind of stable coins, right? Like if a lot of these stable coins, as long as they're well designed, you can see what happens when they're not well designed. But as long as they're well designed, like having a lot of these in existence, like might help kind of like distribute some of the risk. On the flip side, if there's like one that really kind of like takes over and people get way too, hyped about it, and it's not secure, or it's not like it can't maintain its peg properly, it can cause, some disasters. But it's going to be kind of interesting to see how many of these shake out, over the next couple of years, and like which ones stick around. I gotta say, like a couple episodes ago, you were talking about DAI and how impressive that project has been, and I gotta say, like, I agree with you at this point. Like, it works, like it's pretty impressive. It's like it stayed pretty strong.
Yeah, and one thing on your note about like more stable coins, like making everything else more resilient and whatnot, I think that's the interesting part about curve pools, right? Like you have these pools where you can like interchange all these different stable coins with each other, like DAI, USDT, USDC in the 3 pool, and then FRAX created a pool with them. So the idea is that if you have a lot of liquidity in there, then that helps smooth out the volatility, because like you can take your FRAX, you can swap it for any of those 3 more legit, maybe legit's not the right word, more like battle tested, more secure, whatever you want to call it. And so by having that ramp to do that, it's not going to that easily like crash the price if some uncontrollable situation happens.
Right. Yeah. And that's pretty nice. Yeah, I guess the kind of like one of the last things here is like the only thing that's in some ways too bad about all these stable coins that I don't even know how you would start to kind of fix is they're all pegged to USD. So, they all are at the end of the day at the whim of kind of what the Fed decides. And we've seen, like macro, like that's kind of been a problem for a lot of people, because a lot of people want some, store of value where they feel like their money is just kind of safe even sitting around. And over the last couple of years, like that's just not been true because the Fed can kind of do whatever they want. So we're still, these aren't in some ways these aren't resistant to the government and their intervention, right? You're still kind of losing value if you hold on to anything that's pegged to USD. So I think that's like too bad. That's more like very philosophical.
Very interesting you said that, because you are not the first person to think of this issue. A lot of people obviously agree with you on this. And FRAX Finance, I believe this year, so they have the FRAX stablecoin, which is like variably backed by USDC and their own like Luna style seigniorage stablecoin. Anyways, that's their main product. They also launched this year a new stablecoin backed by, or I don't want to say backed, it's called FPI, and it is FRAX Price Index, a new inflation anchored stablecoin that tracks the US CPI. So tracking will be done using Oracle data from Chainlink. Each month we'll see an adjustment to the dollar value in line with the movement of inflation.
Oh, that's kind of sweet. That's so interesting.
So that solves the problem that you were kind of saying. I mean, this is really fascinating. We probably need to research and dig in more on a future episode, but like you're exactly on point with your concern, and people have heard you and are trying to fix it.
That's pretty awesome. Yeah, I think this warrants its own deep dive, for sure. This is exactly like what I was looking for. So I'll have to follow up with you on that one. Maybe next week even. That's sweet. Cool. You guys want to move on to talking about layer 2s a little bit and maybe like roll-ups as well?
Let's do it.
Let's do it.
Cool. So I think, I guess, what is it? Quick introduction to layer 2s. One of the things that we saw a lot in the last bull market especially was basically that transactions were getting really expensive, right? Because there's a lot of load on especially like Ethereum, which is kind of like your layer 1 chain. And so the problem that a lot of people saw immediately was, we're expected to kind of onboard the world onto crypto, which is the dream, I guess. We need to find a more scalable way to kind of do this, right? Like people can't be spending hundreds of dollars for gas, for transactions. People can't be waiting for, minutes for things to go through. And so, people started brainstorming a few different solutions. Like one of those kind of solutions that we talk about a lot is layer 2 as well. Kind of the most common one is actually just other chains. So like other L1 base layer chains, it is a very common one. We saw things like Avalanche pop up. We saw things like, I'm blanking at the moment, but somebody fill me in, like Polygon pop up, whatever.
Solana.
Solana is a really big one. We actually keep seeing them kind of like continue to pop up. But there are other ways of kind of dealing with scalability other than just kind of reinventing and adding more and more blockchains over and over. And so, a couple of these very simple ones are like channels, side chains. I think there's one called like Plasma as well. And then I don't know if you'd call this an L2 or if you'd separate this out into its own category. It's kind of my favorite is Rollups as well. Brian, would you call this an L2 or would you just like separate this out altogether?
Yeah, no, I'd say it's an L2.
Yeah, and so like within rollups, like rollups are the ones that I'm kind of most interested in, and I know the most about. But like within rollups, there's basically two types of rollups that I'm aware of. Like one are ZK rollups, which they're like very fast, very efficient. But as I understand, like there's no easy way to kind of like migrate over existing contracts, right? They kind of are their own like new thing, and you need to build on top of them very specifically. Kind of the other set of rollups are called optimistic rollups, and these run an EVM compatible VM. and they can execute the same smart contracts. And so this is really great because it kind of maintains this whole composability dream that that we have, like with smart contracts, and you don't have to throw everything away. And I think one of the big examples of that, I don't know if they're launched yet, I think they are, is Optimism. And so they're kind of trying to be one of these optimistic rollups. So we have a couple of ways of dealing with this kind of like scalability problem. The reason that I'm pretty bullish on rollups is with Ethereum 2.0, especially in phase 1, we're gonna get data sharding. And so data sharding is going to basically allow all of that, like all of the data that we want to, how do I even put this, like securely like store on chain on the L1 in a pretty scalable way. And we just have to farm out kind of computation over to the optimistic rollups. So
Right.
that's kind of what I've been looking at. Sorry.
So, I also am very excited about ZK technology when it comes to rollups, but per my understanding, it's further behind for sure. So like you said, the optimistic ones are out already. Arbitrum, Optimism. ZK ones may be out soon, but it's still like a work in progress. I think, so one thing about rollups is that you can technically use them with any L1. But the reason why they're kind of focused on Ethereum is because Ethereum is specifically building their network to be very rollup friendly. Like you said, their upgrades,
Right.
their data sharding, et cetera, all of those are focused on making it as rollup friendly and rollup focused as possible. So I think that is why you kind of see a lot of them focus on Ethereum, but technically they could work with other like settlement layers too. And I think two things that I read that rollups are really good at versus other L1s is one, there is an escape mechanism if the rollup fails, which means like if you have your money on the rollup and it's kind of tied to a smart contract on the layer 1 network and it fails for whatever reason, like the sequencers go down, rollup stops working, whatever, then you can still recover your money on the base Ethereum layer. So that's like a lot of good safety components there. And another part is that rollups can very easily like integrate with each other, and it's not as difficult as like some random L1s trying to compose with each other and whatnot. Like rollups,
Right.
from my understanding, very easy to do that, and those are two huge benefits in my eyes.
Yeah, because that means you don't really have to bridge, right? If you're using rollups, you don't really have to bridge stuff.
I mean, what do you definitely have to, you still have to bridge. And actually, it's one of like the big differences between optimistic and zero knowledge rollups is, so the bridge over is fairly seamless and fairly quick. It's coming back when you want to leave rollups is when there's like very big difference. So optimism, part of the reason like optimism is ready right now, is because it kind of like, well, it's in the name. They make like optimistic assumptions about the transactions that happen on the rollup, right? And so then, at a high level, the way these rollups work is they put a bunch of transactions together and create like a state root and deposit that, or I shouldn't say deposit it, but send that to the L1, and the L1 then is able to reference that for understanding like what transactions happened on the rollup, which is cool because that's how you can initiate rollup transactions on the L1 and vice versa, right? But the reason Optimism like was ready first is really because it is this system where that root is committed to the L1, and then there's like a 7-day challenge period, right? There's some sort of challenge period where anybody can come in and say like, hey, this proof, they can prove that something that was submitted to L1 was incorrect, right?
They can reject the proof, basically. So there's like a proof that's submitted to the L1 and like kind of committed onto that chain, but then you're saying that proof, there's some period that proof can be rejected.
Right. So if somebody submits proof of a fraudulent, basically like a fraudulent submission, then I'm not even clear about the full procedures here, but then it gets rolled back, right? The nice thing about zero knowledge or ZK rollups is actually the finality. So in that case, right, going back to optimistic rollups, the finality is like a week, right? So if you decide I want to exit, optimism, and you want to do it like the canonical way, that it's going to take a week, right? ZK rollups, that can actually be done on the order of like minutes, right? So you can commit the proof. There's like an actual roll-up contract on chain, and it does the validations on, it's able to do the validations, I believe, on the L1, right? And then you get your money back, and now you don't need, you don't have this 1 week challenge period. It also, like, the nice thing is like the way a lot of people get around this 1 week latency is they'll use like bridges, right? I know we'll talk about bridges a bit later, but as we've seen, bridges don't necessarily have the best designs or the most secure designs all the time. So so that exit's a big one. And then you mentioned something earlier too that I think is really interesting to talk about, just within regards to like the roll-up space in general, just so people are understanding, like, typical blockchain, there's these miners that there's like a mempool of transactions, so all these miners that are, mining to compete to mine a new block and include transactions, right? For a lot of these roll-ups, right now you just have kind of like one centralized sequencer, right? So this person or this entity has the ability to order transactions essentially however they want. Right now, I think a lot of these are done pretty benevolently, but I'm not sure anybody has like a clear understanding of how they're going to actually like decentralize the actual sequencing process itself too. So I'm definitely very bullish on rollups, but I think if you're using it right now, you also have to realize like a lot of these are very, very centralized. There is some risk in there, though. They're basically being developed by benevolent entities.
Yeah.
So. I see.
I want to ask you two for your prediction about fees, because per my understanding, rollups are so cheap because they still post transactions to Ethereum, but every transaction within the rollup bundle per se gets to split the cost. So even if the gas fees like 100, if you have like, I don't know, thousands or 10,000 transactions, you're not paying that much. But okay, so the first question is, do you think Ethereum fees are going to decrease drastically because of that? And then the second question is, if rollups do get all the usage and adoption, what do you think happens to ETH, the value of ETH?
Well, I think ultimately if there's any valuable block space to be used, it'll get taken up. So, to answer your question on will it affect fees on ETH, I think over the long term, there's probably some sort of long-term terminal state of what fees look like. I think the envisioned world of what ETH looks like is like you and I, like pretty much nobody interacts directly with the ETH blockchain. Let's say like 5 to 10 years from now, right? Everybody's interacting with these roll-ups, and you can almost think of like Ethereum as a SaaS service for these like roll-up chains, essentially. And so those chains they're the ones that are, paying the fees that run the Ethereum blockchain, basically. And like you said, they kind of like amortize the cost of that over all the transactions that take place on their roll-up. So I mean, I guess
what
the
does
more
value accrue then?
Well, I mean, people are still paying the fees in ETH. right? People are still paying, like they're paying for that low, like the security of the Ethereum blockchain, right? Like the rollup is the most secure a rollup can be is whatever the security of the base layer is. And likely it's going to be less secure than that, right? I mean, we just talked about the sequencers. So, there's a lot of value in being able to anchor your L2 to a very secure, like, stable blockchain, right? Like, imagine if your L2 was on, like, Solana, and that thing's breaking down on you, like, every once in a while.
So,
yeah, I was just wondering, in your vision of the future that you're saying, in DeFi, is it going to be using ETH? Are we going to be using ETH with DeFi, or are we going to be using like Optimism's token or ZK Sync's token?
Well, they still pay fees. Like all these L2s, the fees are still in ETH, right? So they're not in the token itself. Most of these L2s don't even have a token right now. I mean, all of them have very heavily hinted that one's coming. But I'm not sure they know how it's going to be used. Like Optimism hasn't said how it's really going to be. They basically said like, I can't even remember. It was like governance, and then, I think they're still trying to figure out how do you accrue value to it. It may be via some sort of like the sequencer role. Maybe you stake Optimism, similarly to you stake Optimism and you get some sort of right to execute MEV on the transactions that occur on the Optimism rollup, right? But I mean, all of them. I suppose they could always switch out using Optimism, but then you have to keep in mind that their costs, though. So like their revenue, you can think of the revenue is like whatever token they're getting paid in for fees, and then their costs are whatever it costs to commit the final state root like to the L1. So if they start receiving if they receive their revenue in a different currency from their costs, then there's a little bit of like a currency risk they're taking there then. So, I mean, we'll see how it plays out, but yeah.
I think another thing to kind of address your question, Kevin, your question was like, what I inferred from you was, if a lot of transactions are going to start getting bundled, basically, by these rollups, right? Like they're all like maybe 1,000 transactions that would have otherwise gone straight onto the Ethereum blockchain. If those get bundled into one, and that's one commit, status quo, if nothing changes, then, Ethereum should hypothetically get about 1,000 times cheaper, speculation aside. I think the thing about that, though, is like, as people figure out how to make rollups, the usage goes up as well. So it's like, if a lot more people can actually effectively use Ethereum via the rollups, then a lot more people will, right? And I think that there's going to be sort of like a very competitive market where like a lot of rollups and stuff are going to start popping up, and that will offset the kind of loss in a way. So there's going to be a loss of like direct transactions as they existed today for like roll-up transactions, but there are going to be more roll-up transactions because there's going to be more overall usage. And it might not balance out perfectly, but I think that's like one thing that is fairly likely to kind of play out, and especially if there's convergence, like if these roll-ups are very like efficient, I guess you could say, like there could be a lot more convergence from all these like competing L1s onto Ethereum, for example, because Ethereum, to Brian's point, does actually have like pretty amazing security compared to some of these other kind of like more centralized L1s like Solana, right? Like Solana, I think we could all agree is a lot less decentralized than Ethereum, and in many ways for that same reason is less secure, right? And so if we all converge, if all that market share moves over to Ethereum, then there's the price pressure is kind of going to even out to some degree.
Yeah, that makes sense. One thing I was wondering is, okay, so obviously rollups for the end user are going to make things like so much faster, so much more capacity and whatnot. So one prediction is that more like blockchain games can be enabled Because right now, obviously, it's like stupid to put every transaction on chain. I don't even know if any, maybe they do on Solana or something like that. But yeah, I think that is one area where developers get more flexibility to build stuff that previously wasn't possible. But do y'all have any other ideas of like what niches or what areas may benefit from this?
Yeah, I mean, I think that's a good example. I actually think most games will just have their own chain, basically, right? It could be probably not their own like chain. That could just be like I mean, Starkware is trying to do like L3s too. But interestingly enough, actually mentioning Starkware, the computation ability of ZK rollups is actually quite a bit higher. You can do a lot more complex stuff on there, so you can, stuff that would be maybe much more costly or potentially just like couldn't do on obviously L1, but even some of these optimistic rollups. You can do on ZK rollups. So stuff that's a lot more computationally intensive, let's say risk models, stuff like that, could become a lot more attractive on ZK rollups.
That makes sense.
That's one thing.
This is a little bit of a tangent, but one thing that I'm a little bit concerned about for ZK Tech is that it's supposed like going to offer a lot more privacy. Right, everyone's talking about how once that's ready, a lot of things are going to get more private, but in some ways that's good, no lie. But in other ways, like you won't be able to like track the hackers anymore, right? So I'm wondering if you think that regulators are going to like really clamp down on ZK rollups and other ZK tech, because you won't be able to use chain analysis and catch any of the hackers anymore like they can now.
I hope not. And I guess I'd flip it on its head and be like, well, what does ZK enable, right? What it enables is I can prove, something about my life to another entity without having to give them the information about it, right? I think the use case of that is not million times, but infinitely more interesting than being able to stop some hackers. And I'd say this too, just the ability to do that means you actually expose less information that can be hacked too. So you can say we can't track the people who hack a DeFi protocol, but what we can do is we can protect when you have to try to get your credit score. Those companies have no idea what they're doing from a security perspective. Like everybody's probably gotten their private info leaked because of those companies. Well, now they don't actually have to have that private information, right? They can they'd be able to do it based on some inputs that you're able to provide without them actually knowing what the inputs are.
And these are just to clarify, these are non-blockchain ZK use cases that you're talking about.
I mean, they could be blockchain too. I mean, there's stuff like Mina. If you're familiar with Mina, that's a ZK based.
They don't have to be, right? Like with the credit score companies, they can just use just like the algorithmic component of it.
I see. Yeah, I assume they could. Yeah.
For that, are you saying something like, you could create a proof of using like your social security number, your name, I don't know, your date of birth, and you can create a proof and give that over to the entity rather than giving that information directly?
Yeah,
to kind of prove who you are. Yeah.
Yeah, it's like the entity can ask you a question. You can basically prove. You can respond to that question, and they can be sure that it's right without having to know the actual evidence itself. Like the most basic example would be like, I go up to a bar, and I'm like, hey, I'm over 21. But the bartender, the guy gets to look and see what my birthday is, right? Well, not most of us don't care, But now, like, you can prove it without the guy even needing to see what your actual birthday is, right? It's just like a yes or no. But you can see how that can scale to basically everything that we do. So there's a lot of promise in these ZK rollups, and I guess that's more of a ZK technology. But I imagine there'd be a lot of value in that being extended to blockchains themselves too.
Right.
The other thing I think about for regulators is like, banks can expose to regulators, okay, here's our risks, without having to expose it to competitors, right? Or bank, basically can have some sort of summation of risk that regulators can trust without needing to go and expose all the details and positions, all that type of stuff. Not that, yeah.
Cool. Kevin, did you, I noticed that you also mentioned that you wanted to move on to bridges as well, and kind of what you see the future of bridges looking like.
Yeah, I think I also don't have that much knowledge there as versus layer 2s and rollups, but very interested to ask Brian his thoughts on the future of like bridges and interchain technology. We see these things with like how some people say like message parsing is a better, safer approach than like traditional bridges. Can you just give us your thoughts on the landscape and the future of that?
Yeah, I think there's definitely become this idea. So most bridges that people use these days are require some level of trust, right? There's some multi-sig that has some ability to, modify or access tokens that are custodied by that bridge, right? I'm actually trying to think of if there is even a truly trustless bridge out there. I wonder if maybe the L1 to L2 bridges, like those, I think could be considered trustless. Not the ones that are like quick exit, like the canonical ones. I think those could be considered trustless. But a lot of the bridges are either like you said, I think people are going more towards like this message passing idea, right?
What does that even mean, if you don't mind explaining?
Yeah, so I think like there's a couple of different companies tackling this. The one I'm most familiar with is LayerZero, and what they're doing is essentially you have like an outbox on one chain and an inbox on another chain. If you post like a transaction to the outbox, you have like a relayer that is looking at the outbox, relays that message to the inbox in the other chain. At the same time, there's like another actor called an oracle. Traditional, like this could be a Chainlink type oracle, and all they're doing is relaying the state proofs from the blockchain A over to blockchain B. So then when the relayer submits the transaction on blockchain B, they're able to do some like validation, like, oh, okay, like this relayer didn't make up this transaction, like it was actually submitted on blockchain A by this user. And then from there, you can include whatever you want in that message, right? You can include, say like, hey, from Ethereum in theory, you could say, hey, transfer, the USDC I have on AAVEX, if you wanted to. If you didn't want to like go, create change your MetaMask to the AAVEX, pointed towards AAVEX, you could in theory do that from Ethereum using this.
So there's no multi-sig involved at any point in that design?
I don't believe so. I don't believe there needs to be. No, but there is. What there is if there's like collusion between oracles and relayers, then you could, like, if oracles submitted a fraudulent proof that, and they worked with the relayer to like, basically make this fake transaction appear real, then there could be issues there. As far as what it looks like from an implementation perspective in production right now, I'm not sure. Like think about LayerZero. I'm not sure how many oracles they have up and running at this point. I don't know how many relayers they have up and running at this point. In fact, like when we talked to them, we thought like, oh, relayer, that'd be cool to set up, but actually that's like far more complex. So I think I think the relayers are maybe fewer folks than the oracles. Right
Isn't
now.
this a very similar approach to Cosmos's IBC and their hub?
Likely, yeah. I haven't looked into Cosmos all that much, but yeah, I mean, it wouldn't shock me if there's a lot of similarities.
Because people were saying that using Cosmos's approach with IBC would have prevented the wormhole like exploit. Remember how they like pretended to mint something on the Ethereum side to get those assets on the Solana side? And theoretically this wouldn't have happened with this other approach to
Yeah.
bridging.
I'm not sure if that's the case. I would be interested, because in my mind that seems like just a smart contract error, right? And you could make a smart contract error, like message passing doesn't eliminate smart contract errors, right? What would eliminate is stuff like the Ronin hack, right? That one was, the bridge was basically like guarded by a I don't even remember what it was. I think it was like a 5 of 9 or something like that.
5 of 9 multi-sig.
Yeah,
exactly.
And the hackers were able to get 5 of the keys and drain them all, and like basically drain the bridge, right? Would it prevented wormhole though? I'm not sure actually. I feel like it wouldn't, but I could be wrong.
Interesting.
Could be wrong. I don't know. I would have to see who said that or what. Yeah.
Sounds good.
Well, I think that's pretty much time for us. Thanks, guys, for joining, and we'll see you again next time.
Sounds good. See y'all.
See ya.
Thanks, guys.